Hi everyone, welcome back to my channel. My name is Tess, and in this video, I'll be sharing with you some of my personal highlights from Buffett's 2022 annual letter. So I've also included the entire letter in the description box below, so do remember to open it and you can just feel free to read through the entire letter if you're interested. So without further ado, let's just dive right in. So as usual, it's sort of Buffett's tradition to start off the annual letter by sharing Berkshire's performance compared to the S&P 500. So in this year's letter, he shared that Berkshire has a compounded annual gain of 20.1% compared to 10.5% of S&P 500. And the overall gain if you were to invest in Berkshire from 1964 all the way to 2021 is a percentage increase of 3,641,613%. And this is compared to the S&P 500, which is an increase of about 30,000%. So to put these numbers into perspective, if you were to invest in Berkshire over the last 50 or so years, you would have actually gained a 122% increase in your overall gain compared to if you were to just invest in S&P 500. Berkshire is a company that has a track record of 50 over years and it has also consistently outperformed the market. And of course, not to mention, it is helmed by one of the world's greatest capital allocators and investors, Warren Buffett. So let's just hear what he has to say in this year's letter. The shareholders of Berkshire Hathaway. Charlie Munger, my long-term partner, and I have the job of managing a portion of your savings. We are honored by your trust. Our position carries with it the responsibility to report to you what we would like to know if we were the absentee owner and you were the manager. We enjoy communicating directly with you through this annual letter and through the annual meeting as well. Our policy is to treat all shareholders equally. Therefore, we do not hold discussions with analysts nor large institutions. Whenever possible also, we release important communications on Saturday mornings in order to maximize the time for shareholders and the media to absorb the news before markets open on Monday. A wealth of Berkshire's facts and figures are set forth in the annual 10K that the company regularly files with the SEC and that we reproduce on pages K1 to K119. Some shareholders will find this detail engrossing, others will simply prefer to learn what Charlie Munger and I believe is new or interesting at Berkshire. Alas, there was little action of that sort in 2021. We did, though, make reasonable progress in increasing the intrinsic value of your shares. That task has been my primary duty for 57 years, and it will continue to be. So as we've read from the letter, Warren Buffett isn't someone who enjoys or even believes in talking to analysts about Berkshire's performance in the short run. And that is also one of the reasons why he moved to Omaha, Nebraska, which is far away from the hustle and bustle of New York City, whereby the analysts there will always be asking what are your expectations and your prospects for the stock. So I think this is also a useful trait for investors to have, which is not to just focus on the short-term expectations and the short-term earnings for the company, but rather look at the long-term picture and focus on what the company has to offer in the long run. In the next section, Warren Buffett highlights what you own. So here he says, Berkshire owns a variety of businesses, some in their entirety, some only in part. The second group largely consists of marketable common stocks of major American companies. Additionally, we own a few non-US equities and participate in several joint ventures or other collaborative activities. Whatever form of our ownership, our goal is to have meaningful investments in businesses with both durable economic advantages and a first-class CEO. Please note particularly that we own stocks based on our expectations about their long-term business performance, and not because we view them as vehicles for timely market moves. That point is crucial. Charlie and I are not stock pickers, we are business pickers. So the point that Buffett is trying to make here is that both Warren and him are business pickers and not stock pickers. And this is essentially about having the ownership mentality when we choose to invest in business. So we don't just invest in a business as a way to earn money and grow our wealth, but rather we must think like a CEO and analyze a company as though you are a CEO. Because when you invest in a company, you are essentially owning a part of the business. Next, he also shares a common perception that people have of Berkshire as a large and somewhat strange collection of financial assets. In truth, Berkshire owns and operates more US-based infrastructure assets, classified on our balance sheet as property, plant, and equipment that are owned and operated by any other American corporation. That supremacy has never been our goal, It has, however, become a fact. So Berkshire actually invests in tons of companies, from insurance, railroads, payments, and so on. And when you're owning a piece of Berkshire's stock, you're actually owning indirect ownership of all these other companies as well. So Warren Buffett actually highlights that there are four key giants, he calls it the four giants, that contributes to the majority of Berkshire's value. So these are the four giants which accounts for the large chunk of Berkshire's value. Firstly, insurance business. The insurance business is made to order for Berkshire. The product will never be obsolete, and sales volume will generally increase along with both economic growth and inflation. Also, integrity and capital will forever be important. Our company can and will behave well. So one of the biggest advantage that Berkshire gets to enjoy from its insurance business is float. So float is essentially the premiums collected from insurance, and this allows Berkshire to invest other people's money for a cost at close to nothing. The second giant is Apple, which came to a shock when Warren Buffett actually invested in Apple a couple of years ago, and people were thinking, why does Warren Buffett invest in a tech company? But I believe Warren Buffett don't see Apple as purely a tech company, but he believes that Apple actually has the characteristics of being a brand that is very close to people's heart and has generated so much brand loyalty and consumer trust. It's almost like Coca-Cola. So it says here that Apple, our runner-up giant as measured by its year-end market value, is a different sort of holding. Here, our ownership is a mere 5.55%, up from 5.39% a year earlier. That increase sounds like small potatoes, but consider that each 0.1 increase of Apple's 2021 earnings amounted to 100 million. We spent no Berkshire funds to gain our accretion. Apple's repurchases did the job. It's important to understand that only dividends from Apple are counted in the GAAP earnings Berkshire reports, and last year, Apple paid us 785 million of those. Yet our share of Apple's earnings amounted to a staggering 5.6 billion. Much of what the company retained was used to repurchase Apple's share, an act we applaud. Tim Cook, Apple's brilliant CEO, quite properly regards users of Apple products as his first love, but all of his other constituencies benefit from Tim's managerial touch as well. So moving on to the third giant is BNSF, which is a railroad business. BNSF, our third giant, continues to be the number one artery of American commerce, which makes it an indispensable asset for America as well as for Berkshire. If the many essential products BNSF carries were instead hauled by truck, America's carbon emissions would soar. Your railroad had record earnings of $6 billion in 2021. Here, it should be noted, we are talking about the old-fashioned sort of earnings that we favor. A figure calculated after interest, tax, depreciation, amortization, and all forms of compensation. Our definition suggests a warning. Deceptive adjustments to earnings, to use a polite description, have become both more frequent and more fanciful as stocks have risen. Speaking less politely, I would say that bull markets breed bull-related bull. BNSF trains traveled 143 miles last year and carried 535 million tons of cargo. Both accomplishments far exceed those of any other American carrier. You can be proud of your railroad. So here, it's interesting to know that the railroad business BNSF has been performing really well in 2021 with a record of $6 billion in earnings. And of course, this is when Warren Buffett also poked holes at the EBITDA metric, and he actually prefers measuring earnings after interest, taxes, depreciation, and amortization. Last but not least, the fourth giant is BHE, which stands for Berkshire Hathaway's Energy. BHE, our final giant, earned a record of $4 billion in 2021. That's up more than 30-fold from the $122 million earned in 2000, the year that Berkshire first purchased a BHE stake. Now, Berkshire owns 91.1% of the company. BHE's record of societal accomplishment is as remarkable as its financial performance. The company had no wind or solar generation in 2000. It was then regarded simply as a relatively new and minor participant in the huge electric utility industry. Subsequently, under David Sokol's and Greg Abel's leadership, BHE has become a utility powerhouse, no groaning please, and a leading force in wind, solar, and transmission throughout much of the United States. So if you're not familiar, Warren Buffett actually announced last year that Greg Abel would most likely be the successor of Berkshire Hathaway. So Greg is actually the vice chair of the non-insurance business in Berkshire and also the head of BHE, which is Berkshire Hathaway Energy. So now let's dive into some of the companies that Berkshire owns but don't have direct control. Now let's talk about companies we don't control, a list that again references Apple. Below we list our 15 largest equity holdings, several of which are selections of Berkshire's two long-time investment managers, Todd Cobbs and Ted Weschler. At year-end, this valued pair had total authority in respect to 34 billion investments, many of which do not meet the threshold value we use in the table. Also, a significant proportion of the dollars that Todd and Ted manage are lodged in various pension plans of Berkshire-owned businesses, with the assets of these plans not included in this table. So from this table, we can see that the largest position is in American Express at about 20%, following which it would be Moody's Corporation at about 13.3%, and Bank of America at 12.8%. Next, Warren Buffett shares that Berkshire is actually sitting on $144 billion in cash and cash equivalents on its balance sheet. And while that might seem like a huge chunk of money, there is a reason for that. Berkshire's balance sheet includes $144 billion of cash and cash equivalents, excluding the holdings of BNSF and BHE. Of this sum, $120 billion is held in US Treasury bills, all maturing in less than a year. That stake leaves Berkshire financing about half of 1% of publicly held national debt. Charlie and I have pledged that Berkshire, along with our subsidiaries other than BNSF and BHE, will always hold more than $30 billion of cash and cash equivalents. We want your company to be financially impregnable and never depend on the kindness of strangers, or even that of friends. Both of us like to sleep soundly, and we want our creditors, insurance claimants, and you to do so as well. But $144 billion? The imposing sum, I assure you, is not some deranged expression of patriotism, nor have Charlie and I lost our overwhelming preference for business ownership. Indeed, I first manifested my enthusiasm for that 80 years ago on March 11, 1942, when I purchased 3 shares of City Services preferred stock. The cost was $114.75 and required all of my savings. The Dow Jones Industrial Average that day closed at 99, a fact that should scream to you, never bet against America. After my initial plunge, I always kept at least 80% of my net worth in equities. My favorite status throughout that period was 100%, and still is. Berkshire's current 80% or so position in businesses is a consequence of my failure to find entire companies, or small proportions thereof, that is, marketable stocks, which meet our criteria for long-term holding. Charlie and I have enjoyed similar cash-heavy positions from time to time in the past. These periods are never pleasant. They are also never permanent. And fortunately, we have had a mildly attractive alternative during 2020 and 2021 for deploying capital. Read on. And that was another famous line by Warren Buffett, never bet against America. And you know, $144 billion in cash, that is really a huge chunk of money for any company to imagine to be sitting on. But we have to bear in mind the size of Berkshire. It's really such a huge company. And despite having this amount in cash, this still means that Berkshire is actually invested 80% in equities and the rest in cash. And also, it's not that they don't want to invest in companies, but rather they fail to find companies that actually meet their criteria for a long-term holding. Hey, if you've enjoyed the video so far, why not give it a like and subscribe? Did I mention it's also free? And also, you can comment down below what is your favorite takeaway from this video, or perhaps if I've missed out anything. And now let's dive into the last few segments of the annual letter. So we know that there are a couple of ways for a company to increase shareholder value, and that can be through internal growth, M&A, or even share repurchases. So Buffett actually outlines 3 different ways to increase shareholder value of Berkshire, and he also weighs the pros and cons of each method. There are 3 ways that we can increase the value of your investment. The first is always front and center in our minds. Increase the long-term earning power of Berkshire's controlled businesses through internal growth or by making acquisitions. Today, internal opportunities deliver far better returns than acquisitions. The size of those opportunities, however, is small compared to Berkshire's resources. Our second choice is to buy non-controlling part interests in the many good or great businesses that are publicly traded. From time to time, such possibilities are both numerous and blatantly attractive. Today, though, we find little that excites us. That's largely because of a truism. Long-term interest rates that are low push the prices of all productive investments upward, whether these are stocks, apartments, farms, oil wells, whatever. Other factors influence valuations as well, but interest rates will always be important. Our final path to value creation is to repurchase Berkshire's shares. Through that simple act, we increase your share of the many controlled and non-controlled business Berkshire owns. When the price-value equation is right, this path is the easiest and most certain way for us to increase your wealth. Alongside the accretion of value to continuing shareholders, a couple of other parties gain. Repurchases are modestly beneficial to the seller of the repurchased share and to society as well. And then in the last paragraph of this segment, he shares, finally, one easily overlooked value calculation specific to Berkshire. As we've discussed, insurance float of the right sort is of great value to us. As it happens, repurchases automatically increase the amount of float per share. That figure has increased during the past 2 years by 25%, going from 79,387 per A share to 99,497, a meaningful gain that has, as noted, owes some thanks to repurchases. Warren Buffett also believes that one of the best ways to increase shareholder value is through share buybacks instead of dividends, and he actually doesn't like companies that pay out dividends. And in the last two sections of the letter, it is more of a personal touch by Buffett, whereby he first shared about the passing of Paul Andrews, who is the CEO and the founder of TTI. Through this short sharing, we can really tell how much of a good relationship that Buffett has with people, with his partners, and how much friendship they've actually created as well. And towards the end, Buffett also shared his personal anecdotes, and as well as some advice for university students. He shares that he enjoys teaching and writing, which has helped him to develop and clarify his thoughts. And here's his advice for university students. He urged them to seek employment in the field with the kind of people they would select if they had no need for money. Realities, I acknowledge, may interfere with that kind of search. Even so, I urge the students never to give up on the quest, for when they find a sort of job, they will no longer be working. So essentially, what he's trying to say here is to find a job that doesn't feel like a job. And even better, if you can find a job whereby you feel like you can tap dance to work, which is essentially what turned out for him and as well as Charlie Munger, whereby they discovered that investing was really for them, and they met through this wonderful journey and created a company together. And with that, I hope you've enjoyed the video of some of my personal highlights from Berkshire's 2022 annual letter. And if you'd like to stay updated, you can consider subscribing to my newsletter at tessang.com/newsletter. And I'll see you again next week.